get across the market open now. Jessica Amir joining us from Moomoo. Jess, welcome back. Of course, turmoil in markets at the moment, given what Donald Trump has unveiled, although maybe there's a reprieve ahead, certainly as far as Mexico and Canada are concerned.
Yeah, you're spot on. So I guess it seems, as we were saying just before we kicked off the record button, it seems that Donald Trump is using these tariff threats as a negotiation tactic. So we all know that he's paused the tariff on Mexico, and now looks like Canadian tariffs are paused for 30 days. But nevertheless, we are seeing stocks sell off heavily. So the Nasdaq 100 and the S&P 500 are down for their second straight session. But what is really interesting is that traders are becoming increasingly bearish. They're betting for volatility to rise. And if the first month is something to go by, then we do know you should be keeping your eye on the VIX. It seems every time the VIX over the past several years, when it's risen above a reading of 20, it seems that we see a flood of investors buy into the Nasdaq 100. But it seems that didn't really happen overnight. So the Nasdaq has extended its sell-off. And what actually happened, Andrew, is we saw the VIX rise above a reading of 20. So the market's fear gauge rose by 11%, if we can call it that. So its highest level in a month. And this basically suggests that sophisticated investors are betting for more downside. So that's something to be cautious of. But on the flip side, we're also seeing investors increasingly sell any rips in the market. So expect money to continue to, I guess, come out of the market until we know what on earth is going on. Remember that markets do like certainty. We don't really know what's happening, but for the most part, traders, sophisticated investors are really repositioning portfolios, bracing for US GDP to fall by 1.2% in the wake of these tariffs, and also for higher inflation. That's what it's all about.
Interesting, we saw a bit of a rebound in tech stocks as well. What do you see happening there, and particularly with a focus on Nvidia, obviously, given how far it moved last week in the wake of the DeepSeek emergence?
Yeah, it's a really good question. So 2 sessions ago, we saw Alibaba come out, and they're basically launching an AI model of their own sorts. And I guess this is another red herring moment for Nvidia, that Nvidia is probably not going to be the dominant player in AI in maybe 10 years' time or 20 years' time. So that's exactly what the market is adjusting for. They're positioning for, I guess, a little bit more of a bearish picture in the long-term horizon. That doesn't mean that we're going to see the Mag 7 walk away from Nvidia and take their contracts out of Nvidia and quickly pivot to these other players, because the simple fact is they don't have the technology ready to roll out for the likes of Microsoft and Meta and Amazon to move their technology to these other Johnny-come-lately new players. But if we look at the technical indicators, they're very bearish for Nvidia. And so Nvidia has just fallen under its 200-day moving average. This is suggesting that traders are bracing for, I guess, maybe, an extended bear market. So the last time that Nvidia actually fell under its 200-day moving average was way back in 2022. Nvidia actually then, after falling under its 200-day moving average, it then popped up very briefly, rising 33%, and then it quickly sold off again and entered an extended sell-off for about 6 months. And then traders were down for the count. And then those who bought the dip, I guess, rejoiced back in 2022, because ever since then it continued to hit record high after record all-time high. All we're saying is prepare for an extended pullback. You might be expecting a rip, and that rip might be from their results. Of course, we know they're due later this month. Reading between the tea leaves, I guess if history repeats itself, they could pop after their earnings results, and that's probably when you might be seeing traders and sophisticated investors sell that rip before it maybe enters a protracted pullback period. So that's something that people are seriously considering, Andrew.
Meanwhile, Jess, what are you seeing on the local market? Interesting also a focus on the gold miners at the moment, given bullion reaching another record.
Yeah, absolutely. The gold bulls are back, and more calls are continuing to increase for gold to explore more record all-time highs this year. And it's for good reason. China has come out and they've increased their allocation for gold holdings week on week. But globally, this is happening as well. You'd be expecting this to continue given the mass uncertainty sweeping across markets. It's also really pleasing to see, Andrew, that ETFs have increased their ETF gold holdings. And this is what I guess what we were expecting to really see higher highs for gold. So you might be expecting the retail army to follow suit into gold now. So this is something that you should seriously be considering in your portfolios if you haven't already. I think it's really pleasing to see the fact that gold is up now 7%. It's the best performing commodity this month. Actually, ever so slightly beating gold is silver, but when gold goes up, silver typically does as well. So that is for the benefit of gold producers as well. But on the flip side, though, we are seeing a lot of pressure now mounting in aluminium and copper. Meanwhile, the US is ramping up their own production of steel. And just before I popped up today, I saw that US steel mills, Andrew, are now pumping out record amounts of steel in terms of the increase of capacity week on week. It's now up 73%. So the US is really making sure that they've got their finger in lots of pies and making money from everywhere they can. So that is something that'll probably pressure down our steel producers as well.
And what are you seeing with the banks at the moment, Jess? Obviously, we know the concern from investors given the valuations there at the moment. Technically, are you seeing any movement there?
Yeah, so it's not looking very good for CBA. So CBA recently flagged what's called a triple top. So it subsequently hit three higher levels at three intersections. This is quite a technical bearish signal, suggesting that CBA could be pulling back. And it's all for good reason. Last week, we saw the dollars and cents come through in the numbers. Property prices are now falling sharply, I guess some could say. That's good news for some who haven't bought a property yet. But on the flip side, it's not very good for CBA's net interest margins. So property prices now falling for the second straight month in three key capital cities. Not very good for those who are expecting a turnaround in CBA's results. So CBA's results might, I guess, be a little bit more ominous than expected. But the reality is that the technical indicators are even more glaringly, flashingly ominous, suggesting that downside could be ahead for CBA. The fact is that CBA, of course, just as a reminder, it's not only the biggest stock on the Aussie share market, the biggest bank. So when that bleeds, markets tend to follow. So perhaps, I guess this is something that we do need to consider, maybe lightening the load or maybe looking for keeping some cash on the sidelines if we do see that sharp pullback in CBA and more broadly the Aussie share market.